Hi there everyone and welcome to this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances and you need to decide for yourself if it's appropriate to you. Okay, so I'm going to do things a little bit differently today. I'm going to do the technical analysis part right at the end, and we'll talk about some of the things that are going on out there beforehand. So just want to start off to talk about COVID at the moment and vaccines. Look, there's a lot of uncertainty out there at the moment around the vaccine rollout, guys, not just locally, but overseas as well, right? So obviously the vaccine's not getting rolled out anywhere near as quickly as anyone really wants, especially locally here, now that we're only vaccinating people over 50, right? So, there's that big uncertainty locally that's really seen the travel sector pull back a little bit here. So the likes of Flight Centre, Webjet aren't doing too well on the back of this. But also what people aren't talking enough of really yet is how this could really slow things down in the recovery sense. So we've had this great boom recovery since sort of mid of late last year where we went through all the lockdowns. Yes, all the economic data is looking fantastic when you compare it to the lows of last year. But where to next? Okay, if we don't start opening up the doors to immigration again, our economy is just going to lag. Okay, so we're just going to slow right down unless we start getting some travel back. We need the tourism and we need immigration to keep our housing market strong. The housing market's been very, very strong recently because interest rates are so low and it's just playing catch up, right? There's plenty of people still trying to get in that couldn't get into pre-COVID. Now the conditions are even more favorable for those people to get in, therefore you get that little rally here. But that rally's got a roof on it unless you've got immigration, okay? We don't have enough population growth to maintain this type of growth in the housing market that what we've seen. So vaccines is really a big thing in the US. Also, they've got too much of that one type of vaccine, whereas now not enough of the population want to take the vaccine or can take the vaccine, so they're going to struggle to hit that herd immunity that everyone's talking about. So I don't see this talked about enough on the mainstream media though. That is just starting to surface now. I wonder whether that's going to be maybe one of the triggers that sees a small pullback this month. But one way or the other, just keep an eye on this space, guys, okay? These types of things never go as smoothly as what we want them to, okay? We haven't had any big pullback in the market for a while. This is one of those things that you really got to keep a sharp eye on from a market point of view, both here and in the US. Stimulus is the whole savior here, right? Without the massive amount of physical and monetary stimulus, markets wouldn't be where they are right now. We know that, okay? The thing is, locally, we don't expect any more stimulus to hit. We've got the budget next week. We'll talk about that a little bit more soon. But in the US, we do have more stimulus to come. We've got basically Biden's infrastructure spending bill, whether he cuts that into 2 or 3 bills, who knows, but that's still a big amount of money to hit the economy. There's still a huge amount of Fed money being splashed around, and none of that seems to really have any signs of changing anytime soon, right? We expect a couple more years of very, very strong central bank stimulus, very low interest rates. So for now, overall, I'm still very bullish the market just on the back of that, okay? Bullish medium to long term, short term, well, let's see what happens in May, right? Will we get that typical little correction or pullback that we can see this time of year? That's the big question, right? So metals have done very well of recent, and that's really on the back of a few reasons. We've been bullish this material space for quite some time. I've sat long many of our miners for the last 6 months or so, on and off. So basically, guys, it's all coming to fruition. There's a few things pushing this space. Obviously, there's a lot of people gearing up, ready for this massive infrastructure, surge that we're going to see around the world coming out of COVID, as many economies try and get back on track. And a good way of boosting jobs is infrastructure. So that's a big part of the job creation that we'll hear talked about in the budget as well, and so on and so forth. So metals will be, one of the real gainers here. The other big thing is electrification. electric vehicles, turning towards green energy, and the rest of it. There's going to be a huge demand for a lot of the metals as well, in particular copper. So we do continue to expect to see this space perform extremely well in the years to come, whether it be from iron ore to any of the base metals. We think it's going to stay, we'll continue to have very strong demand. Iron ore is getting probably a little bit too high and will eventually pull back, but we're still thinking that's going to happen towards the end of the year, more into that fourth quarter. And then we come across to the RBA update today. Look, not much has changed. Their rhetoric stays the same pretty much every month on month. They're looking for wage growth. They're looking for inflation to return between 2 and 3% band, and they continue to reassure us that there wouldn't be any real change in monetary policy until around 2024. So they're there to stimulate. They're going to stay very, very dovish for the next year or so. Can't see much changing there for the time being. And as I said, the push up in the housing market that we've seen recently may only be temporary. If that keeps pushing strongly, then that might put a bit of pressure on things. But for now, I think the RBA really just want to be seeing some wage growth come into this equation. Okay, so budget next week's the big one for me that could really affect sentiment towards Aussie stocks. You've got a very, in the US, you've got a government that's very keen to stimulate and continue to stimulate, and then we've got a government here that's looking to start to turn those taps off. Okay, we saw the taps turned off on keepers and seekers, and we don't expect them to really look at continually to spend and go into further deficits to help boost the economy. What we will probably see them do is try and balance the budget, which is never really a fantastic thing for asset prices here. So what that says to me, if that's what eventuates, if they don't come out with a strong budget where we see a bit of spending going on, what we'll have to really focus on for growth is certain sectors, certain stocks. We're going to have to really be careful what we invest in here. We really want to be picking stocks that have that overseas exposure, where they're still stimulating a lot, where you're going to see that massive rebound. So once again, we'll be relying on other people's successes to boost our own economy. Okay, so that comes down to the sale in May go away. Is it going to happen this year? Okay, that's the big question on everybody's lips right now. We're already hearing a lot of people coming out talking about the market correction and whether we're overdue. I think the US market's getting to a point where it's due, and let's jump over to the chart and we'll have a chat why. Okay, so you can see overall the S&P 500, which is the top 500 stocks in the US, has been trending up very, very strongly since the bottom of COVID here. So if I draw in my uptrend line, okay, I'd be drawing in something along the lines of this, okay? Give or take a little bit here or there, but one way or the other, the way I see it is it intersects in just around about this 39 level, and I'm happy to call it something around there because that was one of the key reflection levels through here as well. And if the market were to pull back, that'd be one of the main support levels that I want to see hold if I want to see proof of that longer term trending hold as well, the longer term trend hold as well. Okay, so I'll just paint that a different color. Just so you can see that a bit clearer. I might put a thicker line through as well. Alright, so I'm always very much thereabouts with my trend lines, guys. Give or take 100 points here or there. I'm pretty flexible. I'm happy to draw that in as well. Okay. So one way or the other, one thing I like to look at is these moving averages. It gives me a sort of medium-term view of overbought or oversold of the market. And one thing that I'm really noticing at the moment is we're getting quite a big distance away from these averages. Okay, you can see in the past it runs off, comes back to around the 50, 100-day moving average, runs up a bit, comes back. The market never goes straight up on a very steep trend for very long, does it? Okay, every time we get a steep movement, either faced with a very slow grind up after that or some form of pullback. And when we start looking at these pullbacks that we've seen over the period, you've got 4% there. We've got, back over here was about 7%, 8%. Here you had about 10% pullback. These corrections, these pullbacks in the trend are very normal. So 5% there. Back in March you saw about a 3%. That was only a very small pullback. But basically these pullbacks are buying opportunities, okay? So as the buying dries up, which we're seeing a little bit at the moment, as the buying dries up, while the correction has to happen to get people back in again, right? Or you have to have a very positive catalyst to get the people to buy back in at those higher levels. One of the two things have to happen. Now, I'm not going to try and predict which one's going to happen, guys. Okay, we might get some really positive news around infrastructure spending in the US. That bill might get passed, and then bang, we're back off again, right? But we may not either. We may need to see that pullback before things can go higher. So I'm waiting for, obviously, which way this is going to spin. I think there's a high chance you'll get a pullback in the next 6 weeks, but I'm not trading that view until I see a technical signal. Okay, I want to see something set off a break to the downside, then I'll trade whatever I can to the downside and get ready to go long again if it gets back down to one of a few levels. Okay, and these levels might change depending on when the pullback happens, but if it gets back down near 4,000 or 3,900 where I've got that uptrend line, I'll be very keen to go long once more. So you're starting to get a bit of an idea of my view. Still bullish, medium to long term, short term, questioning whether this is overdone, looking for a signal for a pullback. Okay, that's kind of summarizes where my head's at. I would not be surprised to see one more kick up before they pull it back either. Another 100 points up to 4,300, and then a nice little collapse down to 4,000 would be fairly typical to what you can see in May. All right, that whole stay away in May phenomenon that happens. Often you do get that last little hurrah beginning of May before it all pulls back, especially when you've got a nice big bullish trend like what we're seeing at the moment. All right, so coming across to our market, the XJO, it just hasn't got a heartbeat at the moment. We're just very stuck sideways. Yes, we're on an uptrend as well, but we get a whole maybe week or two of activity, then we're faced with another 2 or 3 months of sideways. It's just very typical to our market that we see these sideways phases. Volatility is getting very, very low, and it becomes harder and harder to find those trending stocks in the short term when you're trading, day by day. It's harder to get those continuation movements that you're after to get in and out of trades quickly. Whereas back here through this phase of the trend, okay, we're in and out of trades very quick. Things were a bit more whippy, which meant we were able to turn trades over a lot quicker. In this environment right now, you're leaning on a lot of options trades, a lot more sideways trades like bull puts, bear calls, things like that. Okay, there is stocks that are still moving. You just need to look a little bit harder to find them. Okay, you probably find a good 70% of the top 200 stocks are traveling sideways at the moment as well. Okay, so really that's where we're at, guys. Look, we're coming into May, half a chance of a pullback, so paring back a bit of risk. The markets are looking a little bit overheated, especially in the US, less so for our market. We haven't even come back to our all-time high yet. But the US market's looking a tad overheated, so we're reducing risk a little bit and looking for a breakout either way, ready to trade the next move. Okay, that's where we're at. As I said, there's still a bit of US reporting to go this week, so really wait for that to finish up. You've got the banks reporting this week as well, coming into dividends over the next week or so. It's typically around that middle of May where I start getting a bit more nervous about the pullback coming. This time of the month, I'm still a little bit bullish, guys. I still think the pressures to the upside, one more kick up, is definitely on the table. All right. Okay, I'll leave you with those thoughts. Thanks for tuning in today. Take care and bye for now.